Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus, and we are here today to talk about debt funds and stabilized retail with national triple net tenants. Why a comparison of these two and what I'd like to get out of this? So the background on this is over the last 6 months, there seem to be a lot of syndicators, and especially those in the multifamily space, who have been moving to debt funds. And why this move to debt funds? A lot of it is investors have gotten a little skittish here with the change in interest rates and change in the economy and a lot of unknowns, and raising capital's become hard. There are a lot of people out there, especially in the multifamily space, who've had their prefs paused, who've had capital calls, who've had underperforming assets. We have one. I still think it's a great fund, but it was supposed to pay a 7% pref, and it's been paying 2%. At least it's still making money, but people look at that and they're like, you know what? There's a lot of risk in all this. How can I de-risk? And they want more stability, I think, is the thing. Less risk and more stability. And that's where debt funds come in. So what is a debt fund? So a debt fund is where you're raising capital to build a fund, to build up a pile of cash that can be loaned out. So instead of buying something, you're going to loan it to somebody else. These can be bridge loans. So maybe this is a loan to a developer or somebody who's repositioning while another sale goes through. So they're freeing up cash. They can be construction or mezzanine loans that kind of fill in the middle of the capital stack that pay to get through a portion of the project. Often this is kind of like a construction loan that then once that part's done, that money's paid back and a whole new loan is done. Or sometimes it'll be senior debt that it's, depending on the size of the debt fund, they may buy entire projects. So why? The biggest reasons are steady income and lower risk. So debt funds, because it's debt, has predictable income. Whether these debt payments are made every month or quarterly, there's regular payment on them because there's regular interest payments. So it's more of a fixed income component that appeals to risk-averse investors, especially during this time when a lot of investors are feeling risk-averse. Why is it perceived, or why is it considered to be low risk? And this is because you have a senior position in the capital stack compared to equity. Now, depending on what type of loan, if you're the primary or senior loan, then you're number one in line to get paid. That means you should get paid your interest first, or if anything goes wrong and the property gets distressed and sold, you're first in line, or if you have to take the property back, you're first in line. So you have a higher claim on the assets in case of a default. So this gives a little more stability, because in a purely equity position, you can lose everything. From a debt position, it's hard to lose everything because you got this higher spot in the capital stack. Now, that's where it's important. If you're looking at a debt fund, do you prefer looking for something where you're first in line? That's typically a lower interest rate versus mezzanine debt, because now you're second to somebody, so there's a little more risk. So you typically get a little higher interest rate. So here you're trading risk for reward. Now, from a diversification standpoint, if everything you have out there is equity, this kind of adds some diversification. That's debt. It's a little more stable. It's kind of like a bond versus stocks. So it just diversifies the way your whole portfolio is set up. Now, how the debt fund is used can provide exposure to different sectors too. So there's lots of different debt funds out there. Some of the debt funds are investing in all kinds of different real estate. Other ones are more focused. They're just buying office. They're just buying multifamily, or they're just loaning on office. They're just loaning on multifamily. They're just loaning on diversification. Some of them are loaning on business loans, either loans for ongoing business activity or loans to buy a business so it can diversify into those sectors. So there's lots of different things that debt funds can invest in, almost anything that anybody borrows money against. It can also be a hedge against market volatility. And that's because you got to pay your debts first. So typically those payments on debt keep coming even when the market is more volatile. So if you see a downturn in rents or a downturn in not everything being rented out, the debtor doesn't see a difference in that. They get their same payments either way. So again, this kind of insulates some of the market fluctuations, and it's considered a little bit of a safe harbor during uncertain economic times. Now, part of this, I think, is, we've been seeing people moving to debt funds for safety, but also as the baby boomers age, there's more people looking for steady income versus building up their net worth. So that could be part of it too. So again, the biggest reason I think people are looking at debt funds is the potential for attractive risk-adjusted returns versus an equity position. Now, within debt, depending on who you're loaning the money to, what it's being loaned for, whether you're a primary or a secondary lender, all affects your risk. But typically, you're going to see higher returns with higher risk. So things to consider in those risks is interest rate risks. Where your interest rate you're getting as interest rates go up or down can actually change the value of the loan or the investment. And what that means is when if interest rates were to go, like if you wanted to get out of a debt fund, debt can be sold, loans can be sold. If interest rates go down significantly and you're holding debt at a higher rate, you can sell that debt for a premium because now what somebody's buying is a place to invest their money at a higher interest rate. Now, if rates go up, the value of your debt can go down, but it's not going to change in how it performs as long as the property is stable. But from that standpoint, you don't see the benefit of the change of the rate, but you don't see a change in the money that you're getting for it. Now, the risk is credit risk, and this really comes down to who you're loaning money to. And credit risk, is an interesting thing. I know private debt funds who only loan money to house flippers, small flippers. And overall, this would be considered a higher risk group. But if they've been working with the same people for a long time, and these guys don't fail and they manage their risk, they don't do too many projects, they manage their finances well, this could actually be they consider these to be low risk borrowers because they know them so well and they know their business so well. So some of that is really knowing who you're loaning the money to. Now, if you're just investing passively in a debt fund, a little bit of knowing what the fund is being invested in, how well they know who they're loaning money to, and what's the credit worthiness of the people they're loaning money to. Now, there's still market risk, just like with an equity. If things go sideways and an asset doesn't perform, if this is being loaned for real estate or a business, you still have risk of the asset not performing and the loan going bad. What's considered makes this lower risk is that typically where you are in the equity stack is higher. So typically borrowers will get something back. The other risk is liquidity risk, and this comes with a lot of some of the better performing assets. And I think these are the things we don't know about when we look at the private equity world that nobody tells you about versus just investing in the stock market, stocks, bonds, mutual funds. All these different things are very liquid. You can sell them all at any time. Finding something like this, but this goes the same way whether you're investing in real estate, in syndications, or in debt. You have to find a buyer so they can be sold, but they can be illiquid. And then managerial risk. Who's managing the fund and what's their experience managing a fund? Who are they loaning the money to? This is an important part where a debt fund can seem simple, but I really think there needs to be somebody in the management there who's really an experienced loan officer, banker, somebody who's done the debt side before, because it's different managing a debt fund versus managing a real estate project. And this also comes into the regulatory and legal risks of knowing that the people who are running the debt fund have people involved, have the right lawyers involved, that they make sure they're in the correct regulatory space, because there are some differences here between being seen as a bank and not wading into the bank area if you're not a bank. So it's not risk-free, but typically debt funds, again, are perceived to be lower risk, mainly because you're guaranteed your payment first, and if things go sideways, you're higher in the capital stack. So why do I compare this now to stabilized retail with national triple net tenants? Because as I was talking to one of my associates about a deal like this, and the difference is, most of the time we're looking at most of the people out there syndicating. There's a lot of people doing value add. Why do we do value add? Because value add is ones where you buy a property, the same thing as flipping a house. You buy a beat up property, you fix it up, you add value to it, and you sell it or you rent it for more. Or you buy a retail space that's partially full and you fill it up, you add more tenants, or you bring the rent up. And that increases the value of the property. So you see more upside, but there's more risk in carrying out the plan. So this is really what I'm talking about here is kind of the lowest risk, one of the lower risk categories you can get into. So when I say stabilized retail, means that for the property you're buying, it is 100% rented with long-term leases. That's stabilized. And national triple net tenants mean these are national tenants such as Aspen Dental, Starbucks, Massage Envy, some of these bigger companies that you find in neighborhood strip malls that are national companies, and the leases are guaranteed by the national company. And they're triple net leases, meaning the tenants are responsible. Basically, it's like they own the building. They're responsible for all the upkeep. They're responsible for taxes. They're responsible for insurance. They're responsible for everything. So how does this de-risk it for the owner? So now at this point, if taxes go up, it doesn't affect you because the taxes go back to the tenant. If maintenance costs go up, it goes back to the tenant. If insurance costs go up, which has been a big deal in some states like Florida, the tenant pays those costs. So those are part of their risk and not your risk. So your payments are pretty stable. You got your rent, you have minimal to no expenses, and you get that payment every month from a high quality national tenant. Again, these are like Walmart, CVS, Starbucks. So what are your benefits here? Like we've been talking about, the benefits of the stability of the income. So I see this kind of when I was comparing this, going, well, everybody's been so excited about debt funds. This is a lot like that. The debt fund, you put the money in, you get paid a very stable amount very consistently. And so there's a lot of commonalities here. And you've got long-term leases. So kind of like debt, this can be even longer term than the debt as far as for how long you're going to get this. You have lower management responsibilities. So there's not a lot of work involved, kind of like collecting on debt. The tenants are responsible for their maintenance and repairs. So there's a little bit of work in managing, and often, depending on how you want to run your property, you can have a broker, and in almost every commercial office, there are brokers who specialize in retail, both in leasing them and in managing them. And they have relationships with these triple net tenants. So this is a very easy one to make it completely hands off. You're dealing with credit-worthy tenants. These are national companies that have the chances of them not making their payments are almost zero. I heard a couple stories during COVID where some of these national tenants said, sorry, money's down. We're not going to pay you for the next 2 months. They ended up paying all their rent, but there was a little bit of instability. So that can happen. But that's about the only time I've heard it from these top class national tenants. So what are the advantages that you get compared to a debt fund? If we got stable payments, we got reliable payments. So we're lower in the equity stack versus somebody holding debt. But somebody holding debt still has risk of default if you have a bad tenant or if the tenant doesn't follow through. So here we're saying, well, we've got such good tenants. The risk is so low. I feel like the risk is comparable or lower here that these guys are going to not be paying their rent. So what are the advantages? Big one is long-term appreciation. You hold that debt for a while. At the end, the debt is pretty set. The debt gets paid back with interest. There's not really any upside. If you see a big upside in a market, there's still room for potential growth. And that's when you're buying these, and you're buying these as a low risk. You're buying them in quality communities and quality cities and places that the population is growing, that they're going uphill, and the chance of a major downturn is low. And even if there is a downturn, you have tenants who are going to be some of the last people to look at moving or exiting. So your chance of long-term appreciation is good, with some chance of it being extraordinary. And you also take tax advantages. That's the next benefit because of depreciation and interest deductions. It can also be rolled into a 1031 exchange, deferring capital gains for forever. So you get additional benefit of tax advantages. And there's an inflation hedge. What do I mean by an inflation hedge? That goes back to some of the benefits we talked about in the beginning. If you get inflation where your maintenance services go up, that's not the owner's problem. It's the tenant's problem, where there's tax increases, insurance increases, all these things that where these prices go up. These all with a triple net lease are all the responsibility of the tenant and not of the owner. So again, you've hedged yourself against inflation here. So what are your risk considerations? Because nothing's risk-free. The big one is going to be tenant bankruptcy or financial troubles. If your tenants get in trouble and can't pay their rent. Again, if we're comparing this to debt, you have this same risk with debt. And this was the primary point of my consideration here. Whoever you're loaning money to is your biggest risk. And it's the same thing here with this triple net lease. What's your lease renewal risk? Now, this again depends on the tenant, but a lot of these tenants are very sticky. They only go in certain locations with certain visibility. And once they're there, they don't like to move. And they don't like to move because there's a lot of cost to them to move. And once because they're very good at picking location, they don't tend to just want to pack up and move a block down or move to the other side of town. So there is lease renewal risk. But when you have these national triple net tenants, they rarely move. So there is some of the lease risk is as a lease gets older. If you wanted to sell the property, then you're going to have less value. So on the other hand, but those people will see the value add and knowing they have to release up the property. So you may have more interest there. Or if you sell it with new leases, you're selling it to a different market who are again looking for very low risk assets. Next was market trends and retail sector changes. Again, everything out there you read about, retail, they've been killed by the internet. Retail vacancies are at an all-time low right now. Trends are building is still small. There are certain submarkets where you see new retail going in, but overall, there has not been catch-up growth. So the trend here is that there will still be good tenancy. And again, for the properties we're talking about, this is even a lower risk. We talk about location risk. Again, we're talking about tenants, especially if you're buying one that's already stabilized. They've already shown that they like the place they're in, and they're companies that are very good at picking the right property. The other main considerations, I look at my due diligence list here is, property condition and maintenance. That's always a risk, but you have that again on the tenants are responsible for the maintenance in most of these triple net leases. Regulatory and environmental risks. If you're dealing here with gas stations is one thing. These tend to be standalone. And we're talking more here about neighborhood retail. So we don't see the same regulatory and environmental risks. It's still part of your due diligence, making sure that this property doesn't have some backside that we don't that we don't know about yet. So let's go back and compare the two again. Is the big one income stability? What's a more stable income? We all, when we talk about debt funds, everybody considers them stable because you get regular payments without having to do the work of managing the property, of upkeeping the property. If we compare this to national triple net retail tenants, it's almost the same because they are taking care of all that stuff. And you have if you even have a property manager, it's almost like debt because you still get your monthly payments that are very consistent because you've removed the risk of all these economic changes and you get a very stable income. Very similar there to debt. If you're looking at scenarios for your investment goals and risk tolerance, I consider these to be very similar in risk. And the reason we're talking about this is because, as I've been seeing all these syndicators go to doing debt funds, I'm like, am I doing the wrong thing here? Am I doing the right thing? What's the risk here? And as I went through the equity profile of all the different things you can invest in, kind of came back to this. And it was really while having a conversation with one of our partners about an opportunity they have right now that I was like, well, there's really no more risk here than there is with a debt fund. But the biggest thing I think that you get out of this is you get the ability to do depreciation. You get the tax savings. You can 1031 it to delay the tax payments on it, where you will always pay interest. You'll always pay taxes on interest. You also get the potential for market appreciation, which means if the area you're in goes crazy and prices go through the roof, which has happened in a lot of places in the last few years, you can still benefit from that gain where you don't get that appreciation with debt. Diversification and portfolio strategy, is kind of the last one here when we're looking at our overall investments. If you're not invested in any debt, it can be a good diversification. Can give you access to some different income strategies. To all the people I talked to have been listening to the show, a lot of them are listening to the show because they want to learn more about retail and industrial and entitlement and these other things that are outside of, since most stocks and most stocks are in real estate are doing multifamily. Well, unless you're somebody who's heavy in retail already, you're going to diversify your portfolio with retail. So I think my key points here, and I don't want this to sound like a sales job, but I really think that, debt funds are becoming popular because of the perceived de-risking, perceived low risk, and stable income flow. I think we get the same thing out of stabilized retail with good, strong national triple net tenants. They're going to pay their rent. It's going to be a stable income. They're low risk. And when the corporation guarantees these, even if they decide to decrease number of stores, if they've got a lease, they still pay it unless they've got something in their lease. And that's why, these probably one of the bigger downsides is negotiating these leases can be tougher because they've kind of got their lease and what they want in it. And if you're buying one of these properties, reading your leases is probably the key thing and finding out what their outs are, because some of them will build in outs. But typically if they close a store because they just don't like it, they still pay on that lease, or they have something in to buy the lease out. So you still get paid and then you can release it. So there's some different risks there. But to me, this is about as stable as debt. And when you're talking about the place in the capital stack, both of these, the biggest risk is having your tenant, your national tenant, go belly up. And I don't think we're going to see it with these types of investments. So this is a good one to consider. The key thing here, and I guess this isn't a key thing, but this is something that right now we're looking at. We've got a live opportunity. If anybody's interested, wants to get into retail, wants to dip their toe into commercial real estate, or if they want to dip their toe beyond multifamily, but want to do it in a very low risk environment, want to do it in a fund where you don't have to do as giant of an investment, reach out and let's talk. We've got one available here now. We're going to have multiple other ones flowing in. This is a great space right now. So you can reach out to here either at the podcast, surgeonsyndicate.com and schedule a call, or you can go to thefortresscapital.com and schedule a call. Because of the regulatory environment with syndications, you have to have a relationship. And this isn't just something you plunk it down online. And that's really what these calls are. These calls are to find out what you want to do with your money, what you're trying to achieve with your investments, and making sure it's a good fit. Pretty much all syndicators out there, and I can say for myself in particular, we don't want investors who aren't a good fit and are trying to achieve different things. And so there's no sales pitch here. This is finding out if this is a good fit for everybody, and also checking a box on the regulatory pathway of building a relationship. And that's what the private equity relationship is about, is that we're all getting on the same page and knowing that we're looking for the same thing. So I hope this has been helpful in seeing some of the commonalities and differences between debt funds and stabilized retail with national triple net tenants. If you have any questions, answers, you can respond on whatever format you're looking at. You can give us a call, but we do appreciate you being here, and join us next time here on Surgeon Syndicate.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.